Hello, everyone, and have you stepped out of your comfort zone lately? I find that those who are willing to challenge the status quo often sets what I see as successful real estate investors. I see it in my clients. I see that's what sets them apart from the masses. Real estate investors, from my experience, are often from the middle class. They're homeowners with kids, or the children of homeowners. They have great paying jobs and businesses, and they want more out of their life. And oftentimes, their parents wanted more out of life as well. Um, that can mean so actually the truth about real estate investing is that many investors receive help from their parents, especially the young ones. And when I mean help, I mean like significant financial gifts in the range of hundreds of thousands of dollars, which can also include guaranteeing or co-signing of mortgages. Uh, and you've probably heard stories about folks who've received inheritances. One of our staff received a very sizable inheritance from their grandfathers passing away, leaving behind, I think, about like a $1.6 million free and clear house. So it's left behind to two grandchildren. So yeah, the massive transfer of intergenerational wealth, and the cause of it was real estate. Will that change anytime soon in Canada? Well, immigration, as soon as immigration changes, we see numbers come down. Uh, don't forget when Harper was in office, and this isn't a political thing. This is more of like a dating thing. Well over 10 years ago, when when Harper was in government, he set a record of immigration at like 245,000 new immigrant Canadians during his office, and we're now in the 500,000 immigrant range now. And at the same time, there's articles this week that just came out about how there's massive labor shortages in construction and renovation. So uh, add on that to the difficulty already in building housing. Well, it, uh, it still seems like owning quality small multifamily properties makes sense, and that's the advice we're giving to our clients. Um, Now we've spoken to some new people. We have some new audience members who are new to the value investing world. We have a lot of folks who were buying pre-construction now listening. At least they're now tuning into this show. Um, and unfortunately, a lot of them have negative cash flow properties. Thankfully, some of them do have equity in their properties. They've had them long enough that that at least in the equity they are positive. And We have many clients in the similar situation. They bought single family homes for value, 5, 8, 10 years ago. But with the refinances, for anyone who's done the BRRRR method, one of those R's stands for refinance. So that means that someone took a new mortgage to borrow more money on an existing property, making the mortgage payments bigger, and now with interest rates at pretty uncomfortable rates, pretty high. Even people who've owned property for a long time are negative cash flowing. We've had clients choose to divest them in order to pay down debt, or even turn that money over into properties that can potentially cash flow, like a duplex or a triplex. So yeah, and this is getting people out of their comfort zone. Many of us got into real estate investing thinking that we would buy a property and hold it for like 5, 10, 15 years, pass it on down to family. But times change. So we're always happy to do a portfolio review and equity check with our listeners. And if that's something that interests you, feel free to email us at iwinrealestate. Sorry, that's iwin, at infinitywealth.ca. Again, that's iwin at infinitywealth.ca. Again, we're happy to do portfolio reviews, to do an equity check on how you're doing, because again, many of our clients who are in negative cash flow positions but are positive on their equity returns are choosing to divest. If you want to have a conversation around that, we're happy to help. Like, because to me, I've spoken to some uh, people who aren't our clients. They tell me that they have negative cash flow 1,000 or more on generally their condos, and I have better things to do with my money than to subsidize my tenants' rent. That's just me. So hopefully everyone out there is okay. Hopefully you're equity positive. Again, we're happy to have a conversation if you're interested. But yeah, again, I've never been a fan of condos. I think I've made that pretty obvious on the show. I'm happy to invest in the development of condos. I never want to be a holder of a condo because, again, Condo fees rise typically faster than inflation. Condo boards limit one's control of the property, including what you can do with the property. For example, if you wanted to run a short-term rental. On the other hand, here at Island Real Estate, our clients generally own freehold houses on land, and those with a big enough lot can add a garden suite, add a better, and so just some loose, rough napkin numbers. You can build a garden suite for around $300,000 from scratch, assuming you own the land already. And then our client is renting out her property right now for $2,500 a month. So if she gets that, less the management costs, maintenance costs, vacancy costs, the cap rate works out to about 9.1%, 9.1% cap on the garden suite. So that pretty much beats almost any investment out there, a real estate investment out there. Again, assuming that you already own the land. But that's the point. You need to own a property on land, not a condo in the sky. So if you too would like to invest like one of our 45 plus income property millionaires or multimillionaire real estate investors, and you need a portfolio review, I highly recommend it, especially if you're cash flow negative. If you're not ready for action and you're interested in learning more, we do have an upcoming IWIN meeting, all online on Zoom, where I'll be sharing the latest market update. And I've been digging into artificial intelligence quite a bit in terms of the tools that are available for my business, including being a landlord. So I'll be sharing about the tools that we're using today in our business. AI is going to be a massive disruption for the good, for those who know how to use it. And the tools are just getting better and better. I'm already really impressed with what you can do already with these tools. As always, I'm on a mission for truth seeking to find out what works and what doesn't work in my own business, in my own portfolio. That IWIN meeting is Tuesday, July 25th at 7:30 p.m. Eastern Standard Time. My team and I will be breaking down. My team will be joining us as well. Coach Chris and Steve will be sharing about the highest and best use real estate investments our clients are executing on right now, properties that do actually cash flow, and they even work in this elevated interest rate environment. And the timing to buy actually is pretty strong, because if assuming you're one of those who saved and worked hard, saved, and was prudent with their money, then there's not a lot of buyers out there while interest rates are high, and we'll see more motivated sellers come online as the interest rates stay high for probably at least a year. For those who enjoy an in-person experience, we do host IWIN Mastermind Tours. These are in person, and our next one is Sunday, July 30th in Kitchener-Waterloo, where we meet for coffee. We tour 2 income properties, so we go inside them. We have handouts that with the numbers, the cash flow numbers on those properties, and then we mastermind over lunch. To me, there's nothing better than learning hands-on in person and hanging out with like-minded people in my experience. Make sure you're on my email newsletter to stay connected to all these best-in-class educational events. One can register on my website at www.truthaboutreulestateinvesting.ca. Again, that's www.truthaboutreulestateinvesting.ca. On the right side, enter your name and email, and you'll know about all of our latest and greatest events. If you have a friend or family member who cares about improving their financial future, then feel free to invite them along. Now, speaking of being out of my comfort zone, I've been displaying my terrible golf game, for which I am self-conscious of, to other golfers. While I do love the game and especially the networking, it's painful for me to be consistently slicing my ball into the woods and to regular 3-putt or sometimes 4. If you're new to golf or unaware, these are really bad things. On the positive, the people I'm meeting and getting to know has been awesome. My new friend Susan, for example, has been in the business for a very long time of helping immigrants come to Canada. I asked her, how's business? Her answer, it's been busy. And you know me, I always have follow-on questions. Busier than pre-pandemic? Her answer is yes. To my surprise, I have more questions. Don't they know how expensive it is to live here? She responds with a smile. Yes, that's why they're moving to Hamilton. This type of macro and microeconomic information to me is gold, because it's the information that my clients and I need to know. We as real estate investors have 2 businesses. So never forget, as a real estate investor, you have 2 businesses. You have 1, you're in the business of renting to tenants. And 2, sometimes we do sell these businesses. Hence, I want to own what's in high demand for both tenants and buyers. And the way it's going, it continues to look like we're going to have clients for both, for tenants and for resale. And as long as you're investing in the right asset class, in the right area, and as long as the immigrants keep counting, which it surely looks like that's happening. On to this week's show. We have our friends returning from Calvert Home Mortgage Investment Corporation back to give an update on the private lending market, mortgage market update, including lessons from the downturn. For example, what did in default real estate investors do wrong, and what do they have in common, so that you, the listener, this is leverage, right? So that you, the listener, myself, and my clients can learn to avoid the same mistakes. So please keep in mind, real estate investing can be easily done wrong, and there's obviously less right ways to do it. Ask anyone who speculated on pre-construction and is negative cash flow, like a lot, and especially those who do not have a mean to close on those pre-construction contracts. Long term, that could be a fine investment, but most can't handle today's interest rates and the more difficult lending guidelines. Anyways, on today's show, we have Garrett LaBarre, who's an underwriter at Calvert. He's the guy. So an underwriter, what they actually do is they're the one who reviews mortgage applications from a risk perspective, both the applicant and the property, and determine whether or not to lend. Also, we have Jesse. I'm guessing Jesse's his boss, but Jesse's the vice president at Calvert. He's been on the show before. And one of the magical things about real estate investing is that the asset is so good, the banks will lend me a lot of money, which suits my objective of keeping the deal and the equity to myself. I maintain full control of the asset, and all the upside and profits are mine. On the flip side, all the losses are mine as well. This is why learning about your financing options is absolutely key to becoming a successful investor, but debt is a double-edged sword. As your risk is greater, as you're about to hear in this interview, such is the truth about real estate investing. Some people got the wrong edge of the sword. Since Garrett and Jesse live and invest in Calgary, they share a market and economic update on Alberta, which I know is a hot topic for investors. As we do discuss securitized investments, here the disclaimer is coming, and you can check out Calvert at chmic.ca. Again, that's chmic.ca. Please enjoy the show.
Disclaimer. The information and opinions expressed in this podcast are solely for educational and informational purposes and should not be considered as investment advice. The hosts and guests of this podcast are not licensed financial advisors, brokers, or registered investment advisors, and their comments should not be construed as recommendations or endorsements of any specific investment, security, or strategy. Investing involves risks, including the possible loss of principal. Before making any investment decision, you should conduct your own research and consult with a licensed financial advisor to determine the suitability of any investment for your specific financial situation and investment goals. The hosts and guests of this podcast make no representations or warranties as to the accuracy, completeness, or timeliness of any information discussed in this podcast. The podcast is not responsible for any errors or omissions or for the results obtained from the use of this information. Listeners are advised to use their own judgment and seek the advice of professionals before acting on any information provided in this podcast. The podcast shall not be liable for any damages, including but not limited to direct, indirect, special, or consequential damages arising out of or related to the use, inability to use, or reliance on any information provided in this podcast.
Jesse, Garrett, what's keeping you guys busy these days?
Fortunately, getting to hang out with you.
But because last time was over Zoom because you guys are from Calgary. We're here in the GTA today.
Yep. So yeah, we get to visit with yourself. We get to visit with some of our borrowers while we're here on this trip. We get to visit with some mortgage brokers that we get to do work with, and then also some of our capital sources, bankers and shareholders.
Fantastic.
Yeah.
So let's jump right into it. Are your borrowers happy to see you, hear from you?
Yeah, I think so. I mean, they're always happy to hear from us. Like we were talking about earlier, we're calling all our old clients who bought in that tough time between January and April, and just checking in to see how they're doing, making sure projects are coming along, and seeing how we can help. We're always solution-based lenders, so we want to do what's best for our clients.
Fabulous.
Yeah.
So it sounds like your experience is better than mine because I'm chasing my property management. my property manager for my last month's rent right now.
No.
It's like it's May 11th, so it's a little bit late.
well, don't get us wrong. We during our check-in calls that we did to those borrowers who we lent to during peak times, there are some issues. There are some people who are not going to make as much money as they thought, or worse, lose money. But based on the fact that we saw property values drop essentially 20% in 6 months, we as a fund are very happy with the results, very happy with the performance of our borrowers, and their ability to be resilient through this time. So it was a good exercise we're really glad we did. And I think if you were to poll our borrowers and an exercise they're glad we did, how many banks reach out and say, hey, Erwin, everything okay? Anything we could do to work with you on? Like we literally took that approach and called hundreds of borrowers to see how they were doing.
How many needed help?
How many needed help?
Yeah.
Well, I mean, lots of them needed help in the sense that the properties went down in value so much.
Because I know lots of flippers are losing money. My friends aren't losing that badly because they were pretty smart.
Yeah.
I'm talking like 15K on a property, which is not bad all considering, right?
Exactly. And I'd say that's where the majority of our clients would stand if they lost money, would be around that 10, 15 grand type of thing. So
it's not end of the world.
Yeah, and then it's just talking to them about like their future plans, right? Let's see if you want to continue this. You could take this as a learning experience, or you could say, this isn't for me because I lost on this one. So people have different mindsets, and it depends how long you've been in the real estate investor business too, right? If it's your first flip and you lost, it'd be tough to come back from that.
Yeah, and even when you say how many people did we help, like I'd say all of them, because in some instances help was just somebody to talk to. Like, your plans got flipped up on their head. Is it to sell? Is it to refinance? What should I do? And we're fortunate as a company in that we've been through multiple cycles, and we've seen what works and what doesn't. And what doesn't work is inaction. That's where things compound.
Sticking your head in the sand
projects
is
not getting complete. You're paying our fund a high interest rate. Things are getting worse. So sometimes it's just talking about action and what are the next steps and pointing them in directions and giving them options. So I'd say we helped everybody, but some needed different types of help than others.
Yeah. And clients always want to, well, I shouldn't say always want to, but clients are sometimes nervous to call their lender and tell them, hey, I'm having troubles. Like, that's a tough conversation to have, but we welcome those. Yeah, you have to. Yeah. And we welcome those, and we're good with those conversations. So we like to talk about it, see what we can do to help. And people just need to know, like, it's a good thing to call your lender and be in contact with them. We'll work with you more.
At the end of the day, their success is our success. So to sit there in fear and worry about that stuff, that's not going to be successful. So
because just so you know, I'll apologize to the listener because you and I already caught up last week, so I'll likely miss some things. But one thing we discussed was I actually found read it within the last week. The national average for default is something like 0.16 or 0.19, so it's creeped up, but historically it's still extremely low, right? What are you guys seeing in terms of your own portfolio?
So from a high level perspective, what we've seen, and keep in mind that typically we'll see defaults quicker than a traditional bank lender. And that's because the bulk of our borrowers are typically in and out in a very short period of time. Yeah. So it gives us
sorry, can you just quantify that, like 6 months, 18 months?
Well, in normal market conditions, our borrowers are exiting around every 6.5 months.
Yeah. Okay.
Yeah. And these again are our flip and burr clients. Today in Ontario, actually it's not as bad. Let's say 4 months ago in Ontario, we were seeing that push up to 9-10 months. But in Alberta, they've stayed around 6 months for us. But going back to defaults, we had seen an unprecedented time of low default through to basically let's call it May of 22. And then from May of 22 to October of 22, we saw that really ramp up, but still well within historical averages. So our historical, we use a word of enforcement rate. So that would be people where we're having to take legal steps on. Would be, I think it's, and I might not get this number perfect, but I think we're at like 2.5% of our fund. And so we use the bank's term versus our term are a bit different. We're more liberal with what we consider a default. So we saw that increase significantly. And then over the last 6 months, we've saw that level off. And today we're on a downward trend with defaults. Again, keep in mind, most of the stuff that we lent on during peak is off of our books. So we're lending on today's values in today's market.
And yeah, we think that a big part of that decline now in that historical loss rate is based on those phone calls that we had with our clients. Like that was super proactive and beneficial for us to understand our book and see where we stand. So now we're seeing this decline, and now we're doing deals now in a market that isn't seeing the massive decrease in values. So.
And really, when we look at Ontario stats, things have leveled off for 3 months now in a row, which has us comfortable of deploying capital back into Ontario.
Right. So you're bullish again.
We're happy with the stable statistics. We're also happy with where inventory levels are. So even if there is further pain, we believe it'll be muted because of the low inventory. There's a lot of buyers that are out there, and I'm sure from the realtor point of view, you have people ready to buy. There's just not much product.
Yep. Yeah, there's way more buyers out there.
Yeah.
I think that what people need to understand is there's a lot of smart money out there. So people that did not over leverage, and they're pouncing right now.
Yeah, and that's who we're like the clients that we're lending to today in Ontario are that smart money.
Very good. And sorry, the 2.5. So you mentioned enforcement rate 2.5%. How many properties is that? How many files is that? Like 10, 20?
Well, we have 800 mortgages. So what would that be? 20 properties.
That's so for listeners' benefit. For context, I had my friend in here, Saurabh, who's a Mississauga lawyer. One lawyer office. I don't remember. I think he had 32 power of sale files he's working on.
Wow. So
like that would be considered enforcement?
Yeah. That would be.
So one lawyer, one office, 30 something files, and your guys are under that.
Well under that. Like in Ontario during this period to date, I think we've had, because keep in mind we have a few active. I think the number has been 8 total power of sales, 5 of which we've sold, and through that sale process, what we've seen, to Garrett's point, is for the most part our borrowers have lost very little. Some have lost, the ones that have lost the most significant amount are the ones that were over leveraged, the ones that weren't taking action. So we had to take properties over, or we had to force sale of properties that were not finished, and that guys didn't take action, and those are the ones where we saw losses.
It was typically clients with multiple projects on the go at once and just being way too tight on their cash reserves or line of credit and stuff like that, and running those up. So over leverage, and then just really bad timing on that purchase. Yeah,
and which is it's tough to see those things happen. It's something that we as a company now pay more attention to, right? Like from the risk side, we look at, okay, what are the real contingencies this client has? What is their ability to project manage? We always asked ourselves that, but even more acutely today than ever.
Right. See, for myself, I've only ever bought one property at a time. I would not buy the next property until my property is full, rent's coming in, stabilized. Everyone has a different issue to stabilize, but my tenant's in, I'm getting rent. Now I'll look for the next property. I only want to have one vacancy in my portfolio at a time. I can't imagine people doing 2-3 properties at a time.
And now keep in mind, their model was flipping, not burring. But yeah, you definitely have to have project management acumen. and the ability to source trades. Like the trouble you get in is you have one guy who knows what he's doing, does it well. Like say he has a trade and he has a good team, but then when you stretch that team, cracks show up.
Yeah, you got to make sure the cash reserves are there and the experience is there. But one of the big benefits about Calvert is the fact that we will lend almost all the purchase price, right? Like we do $20,000 down in Ontario minimum, and then in Alberta it's $10,000. And our biggest client in Alberta, he's got about 20 on the go right now. So yeah. So that's a lot to manage, but if you have the teams in place, it's doable.
Right.
And he's been doing this. He's been scaling with us for the last 4 years, I think. So
and he's an interesting case because he's much more cash rich than a lot of our borrowers. Like a lot of our borrowers that use the 20 grand down product, they're just starting out.
Yeah.
Right. So their barrier to just starting out in that they're doing the barrier to entry we're reducing on the capital inside. But they have the experience, they have the acumen, so we support them. This gentleman with the 20 on the go, he's built this over decades, and he's putting 25, 30% down per property, really de-risking us on that end.
He started in the 90s, so like he probably would have started where all these others would have started at that $10,000 down, or doing some sort of loan like that and scaling to the point where we can do all these at a time. Yeah.
Yeah.
But this investor, I'm guessing, if they have 20 deals on the go, I'm guessing they have lots of staff.
Yeah, four contract teams that.
Four teams.
Yeah, four teams that
on payroll.
I don't know that. I don't get into that too much, and that's not something he always wants to share. So
it's a bit of his secret sauce.
Interesting.
Yeah.
Okay. But I'm guessing he's their biggest customer. So they're either on payroll, or he's probably like over 80% of their business.
Yeah, it would be like the contractors for builders, where while they're not on payroll, all of their business is coming from the builder.
Right.
Yeah. So if he doesn't have a property on the go, then they're going to go elsewhere. I think that's the case. So he's always got to keep them moving and buy the next property to do. So.
Right. Sorry, you said, when you said 90s, you said you've been doing this since the 90s?
Yeah.
Right. Okay.
Yeah, he's been in the real estate investor business for a while.
And all Calgary. So he's seen what we love about our Alberta clients is they really understand risk, because in Alberta,
they've seen it.
We get slapped around every 8 years, typically. Market drops 10, 20, 30%. So they understand how to manage their downside. Whereas here in Ontario, we have a generation of investors who haven't seen that.
Yeah.
Although we just did witness it over the last year. Although I think, like we've talked about, it's impressive how quickly it has bottomed and stabilized.
It was really fast.
Yeah.
Faster than I thought.
Yeah, faster than we thought too. We were really concerned that it would compound itself with inventory issues and continue that slide down. But it all data indicates that we've found bottom. Although data can be wrong.
Right.
So
it's kind of the silver lining of rates going up so quickly. They went up quickly, so they stopped pretty quickly.
Yeah, we felt the pain quick.
Yeah.
We ripped the Band-Aid off.
Yeah. Can't wait for that to stop. Because for example, I've shown on the show, like Cherry and I bought 2 duplexes in August 2021, and so we paid like low 800s for them, and then with the downturn, we were under, like, the prices had fallen below what we paid, and like, damn it, we screwed up. I shouldn't have bought those.
Yeah.
And I knew I didn't have a good feeling about it. And now we're back in the black. I'm like, glad I didn't sell those.
Yeah. Like all the investor gurus say, Erwin, it's not timing in the market, it's time in the market.
Time in the market. Timing is pretty nice right now.
It's great to have timing, but you can't rely on it.
Mm-hmm. Oh no, my point is like from what I'm seeing, we're past the bottom.
Yep.
I've been saying on the show and to our clients, for the properties that we transact on, the bottom was August 2022.
Yeah.
And then since then, prices been steadily creeping up.
Yeah.
Right? And then it just keep creeping up until I don't know what.
Well, until there's inventory or less demand, which, are we seeing either of those happen?
No.
Look at the immigration numbers. Look at the employment numbers.
Yeah. And I don't know if you guys caught it. Toronto last night just passed. They got rid of single-family zoning.
Yeah,
we heard that.
I read about it on the news this morning, but we were also talking with Rockstar Real Estate earlier about that, and it'll be a really interesting trend to follow. Hopefully, we see a lot of opportunity for more density in the single family space in Toronto, and that's the business we want to support. So hopefully we see a good trend with that.
Let's get into it, because for example, I think Toronto will set the trend. So for example, I invest a lot in Hamilton. We'll probably be I'm gonna guess about 2 years behind. We have an NDP mayor, so I think she's probably likely on board with something similar as well. So I would guess probably within 2 years we'll probably have something similar in Hamilton. But let's get into it. For example, because I was talking with my investor friends, and we're talking about what happened about the getting rid of single family zoning. So how do you actually invest? So specific to Toronto, you might have to pay like 1.3 for a disaster property,
Right.
that you can convert into a fourplex.
Yes.
Right. So say I want to invest in, say I want to buy that. How can you help? How can you help me?
So we want to focus on the renovation side. So if you're truly tearing it down and constructing, we're not the right lender.
No, my plan would be convert, because I want to do it within the bid.
We love your plan.
Right.
So
So I want my perfect world would be 2.5 story, probably need at least 3,000 square feet, ideally a detached garage. All right, go. I want a fourplex in the house.
let's do a ton of those.
Yeah.
So we'll support on the purchase.
Because that's a lot of money.
Yeah, $1.3 million. We definitely aren't going to do it at 20,000 down.
Oh, come on.
I know. I'm sorry.
Yeah. Anything over 800,000, we're typically going to want at least 10% down.
Oh, okay.
Yeah.
All right, 10% down. Okay.
10% down. Show us that you have the capital to renovate and the ability to renovate.
Right.
Like,
because I'm probably gonna need like 500,000-600,000.
yeah, so that's going to be a trickier one, and we may have to take a good look at our product to try to support the construction side, because the barrier to entry is huge on that.
What I've found too, when people want to get into these bigger projects or multifamily, is they do have typically a portfolio of real estate too that we can possibly tap into as well. So we can blanket another property up to 70%, 75% loan to value and use some of that equity to help with those renovations.
Yeah, very solutions focused. So, a guy like yourself might have a portfolio of properties. Let's say on average they're leveraged with the bank at 60%. We'll take them up to 75 to inject the cash into that property. Yeah, we're always looking for ways to get it done for you.
Exactly. We'll look at your whole portfolio and see what's the best solution for you. Give you options too, because some people won't want to tie in other properties. So they'll say, I can bring on a partner or something, and I've got this other cash, so they want to do that way. But a lot of people will say, hey, I've got this equity here doing nothing for me, so might as well tie that in.
Right.
Yeah. But today, if you're without that property and you want to buy for 1.3 and your cost is 500, it's going to be tough for us to get that deal done.
Right.
Unless you have the money.
Yeah.
So like 10% down, 130 grand, and then you have to have the 400 or 500 grand.
Yeah. Preferably cash.
Preferably cash. Credit. We've seen good joint ventures happen. Like, Irwin's uncle might be looking for yield. Everybody's looking for yield in this environment. Irwin's got a great plan and he's going to back it. So we'll allow that money to come in. Absolutely. As long as we see the money's actually there. You can't just show us, hey, Uncle Joe's lending me 500 grand. We would say, great, show us the bank statement, show us the agreement. Mm-hmm. Ideally, Uncle Joe flows the money into your account, because what we'd hate to see happen is a life event happens to Uncle Joe and now the money's not available and now we're in trouble on the project.
Right. Yeah. And just a reminder to the listener, I'm talking about disaster property. So pretty much no one else is going to touch it.
We
no
love
A
that.
lender, B lender.
Yeah, even I remember it was probably my most recent multifamily, but it was in Edmonton, and it had cockroach infestation. It had
that's mine.
It had like a bunch. It had health orders on title and stuff, and boarded up and all this stuff. So there's certain ones if they.
I haven't seen that before.
We see
health orders on title.
We see opportunity. Yeah, in Alberta, we register our health orders on title. So we see opportunities with those.
I know, but it has to get pretty bad to get to that point.
Yeah, certainly. And there
for
has
the
to be
city government to want to register on title. Now they have legal fees too.
Yeah, they got to provide a specific plan for us to be able to consider that. That's an extreme case. This is not going to be most cases, but a lot of times it's hoarders or just a property that just looks awful on the inside that a lot of people would just shy away from just for the look. But There are opportunities there.
Right, but you guys love it.
We love it. That's where we see opportunity.
All right.
Where
You don't go on site.
where we do. So we always send in. We always do a site inspection. That will sometimes be our staff
In a hazmat suit.
That will sometimes be a third party. So we're always walking the property and understanding not only the property but its surroundings, right? Because maybe the hazmat suit is the next door, and Irwin's looking to buy, and we're like, Irwin, it's going to be hard to rent this out for the market rents you think you're going to get when you have a crack house next door. Yeah. So we spend a lot of time understanding the property and its location because that's really how we manage risk is by doing good loans on marketable properties or soon to be marketable properties.
Because this downturn, like my friends and I, we say like this downturn is the ultimate stress test for anyone's business portfolio. Sounds like you did all right.
Oh, we're really happy with what we did.
Yeah, we feel very comfortable with how we did. Like I said, the big problems that we had were those people that bought January to April. Other than that, we've been super comfortable with our book and what we've done. So
yeah, like we talked about the exercise that we did where we literally went looking for problem files, which not a lot of banks do, not a lot of mortgage lenders do. When we find a problem, we mark to market that problem, so it lives in our financials as here is the problem. And our year end is February 28th. So we just published our year end statements to our shareholders, and with all of that in this terrible year, we were able to produce a plus 10% return to our shareholders. So yeah, we're happy with how we managed the risk.
All right, many directions I want to go. Let's first talk about your outlook for Alberta. And a lot of people are interested in Alberta. What's your outlook for Alberta? You guys still lending? Nothing gonna fall apart? Do you care about oil prices?
We're still excited about Alberta.
The Oilers?
There's a lot of... No. Don't go that far. But there's tons of opportunity in Alberta. Like, oil is still here. There's still opportunities there. We're building in the tech center as well. Like, tech is becoming a big thing in Calgary as well. But just cost of living too. Like, our properties are valued on average, our benchmark price is in the 500,000 range, right? Whereas here it's a little more expensive. So, but like we haven't seen it. We didn't see a big, just a little more. But we didn't see the big drop off that Ontario did, right? Like we stayed flat all the way through. We've been a steady market, so we're really comfortable with Alberta. And
steady low. I think
steady low.
Yeah.
I think Jesse said 20% over 17 years.
Yeah, if you look at when we had a peak in residential real estate in 2007, followed by the financial crisis, followed by a couple ups and downs, and then most recently an upward trend. And values are 20% higher than they were in 2007. And to Garrett's point, all these great things he mentioned, because of that, we're seeing unprecedented migration to our province.
Like the bedroom community for BC and Ontario.
Yeah, and even on the income side, like on an average basis, Calgarians earn more than Torontonians, and real estate is half the cost. We have less income tax. We don't have HST; it's just GST, so 5%. And the quality of life, like you and I were talking, Irwin, earlier. Tomorrow morning we have to go. We're going to stay in Hamilton tonight, and we have to go downtown Toronto for a breakfast at 10. And we're worried about it's probably going to take us 2 hours and probably be
allow for 2 hours.
Prepare for 2 hours and be a bit of a hassle. Whereas in Calgary, you can live 20K outside of Calgary in, let's say, Cochrane. Would be a good example. Cochrane is a town of I think Cochrane is 50,000 people now.
Oh, it's tiny.
Yeah, but that's what we're only a $1.4 million population base in Calgary. So 20K outside. You could be downtown Calgary in under 40 minutes during rush hour. So it's very easy to live in Alberta. You get the mountains nearby.
And you can see them from everywhere.
You can see them from everywhere. So anyhow,
that's the other thing is when we drove into Vaughan, because that's where we were staying last night. And like, what is around here? Like, we didn't see anything, but we're close to Toronto. Like, that's the crazy part is there's no infrastructure. Like, there's a couple condo buildings. That's about it.
In saying all this, we love Ontario.
Yes, we do love Ontario,
and we think Ontario has a bright future. But going back to Alberta, we're very comfortable with lending in Alberta. We're very comfortable where our economy is. One thing we have to be wary of is that our economy does move with energy prices. But the outlook on energy is it going to drop below $60 a barrel in the near future? Mm-hmm. The smartest people say not likely. So, but also like Garrett said, we are finally diversifying our industries. There's a lot of tech happening. There's a lot of clean energy solutions. Mm-hmm. There's a lot of
both Edmonton and Calgary diversification, or mostly Calgary.
Edmonton has always been diversified, more on the public sector. So that's where our capital is. That's where a lot of public sector activities are. But both cities also have a big education hub, a few universities, well regarded worldwide. So yeah, we're both Edmonton and Calgary. We're really confident, and that's where 90% of our Alberta money is.
Do you know your split between the cities?
Yeah. I might not get it perfect. I think it's 70-30, 70% in Calgary. And now that's because Calgary is our backyard. So we understand a lot better. It's a lot easier for us to deploy money.
Yeah, also I think the biggest mortgage brokerages are in Calgary as well.
Yeah. That shouldn't matter. It should really depend on where the opportunity is.
Should.
It's just what they know. Like, and it's what we know. We know Calgary.
Mm-hmm. Intimately.
Best.
Yeah.
So you're still... Yes. I forget what the number was. Calgary gained like 50 or 80,000 people just from Ontario last year.
It was a big number. Yeah, unprecedented migration.
Oh yeah. You guys must think the prices here are nuts. Do you not?
We do.
Like literally. Okay, so I live in Oakville. I think people know it's not the cheapest. And a friend of mine had to put an offer on a house in damn it, what's the Canmore?
Okay.
Oh, yeah.
Right. So he's got beautiful view. It's like 3,000 square foot, 4-bedroom, and he's telling me it's like 1.5.
And we think that's wildly expensive, by the way.
But like, isn't Canmore expensive?
Yes. Canmore is the most expensive area within Calgary.
Right.
Yeah, and it's only.
But you want to be close to Banff, isn't that why you live in Canmore?
You're literally smack dab in the mountains.
And Canmore is just as nice too, but I mean, it's only 10,000 people. It's like 10,000 people, and that price.
So is your friend thinking that Canmore is a good deal or an expensive deal?
Oh, he thinks it's expensive. I'm laughing.
Right.
I'm laughing because 1.5 don't get you much in the
But
GTA.
you don't think that's that expensive?
No,
because of your Oakville.
You do not get a view at 1.5 in Ontario.
Right.
Yeah.
Whereas that 1.5, you're waking up smack dab in the mountains.
Yeah.
In this world class city.
Yeah. World class skiing.
World class. Yeah.
Right.
Yeah.
No.
Town. But yeah, Canmore, we've seen big growth. Like Canmore, you drive around, and because you're an hour away from the Calgary International Airport, you have Europeans buying in Canmore quite a bit because it's cheaper than buying in Zermatt and Switzerland and that kind of stuff.
And you can't buy in Banff, right?
No.
Yeah. So this is the next closest thing.
You can if you live and work in Banff.
Imagine it's pricey.
But if you don't live and work in Banff, you cannot buy in Banff.
Yeah.
I'm guessing it's pricey.
Yeah, similar to Canmore.
Yeah. But it's mostly businesses. I feel like people who are buying in Banff are getting like bed and breakfast, that type of stuff. Airbnb, there's a couple. I don't know. There's not many. So.
Yeah, you'll have like these millionaires that want to live in Banff, so they'll buy a convenience store.
But yeah, most will buy in Canada.
Like the bad part about living in a tourist town is the tourists.
Yeah.
Festivals and weekends is probably just nuts.
Yeah.
You can't get a table at your favorite restaurant.
Not on weekends. Not in the summer.
Probably not.
No.
Yeah.
Okay, so outlook for Ontario. Prices are nuts here. No one can afford anything.
Yet they're somehow affording it.
Yeah. Okay.
But it is one of the things that we worry about is how stretched Canadians are. We're not seeing it as bad in Alberta because what we just talked about, but the debt burden is worrisome. Like it's tough to do the math on how people are surviving, the average person, with how much housing costs. So, but what we're seeing again, as it relates to the microeconomic data, is you got hardly any supply, you got a ton of demand, and families and individuals are figuring out ways to make it work. They're living multi-generation. They're staying with their parents longer. Parents are passing down wealth to children in order to buy housing. So we're comfortable with the values, believe it or not. It just, from a Calgarian's perspective, is like, how do you make it work? But they are making it work.
Yeah, but we don't do a lot of lending right in the GTA area. Like, that's not our main focus.
Right.
We do some, but our main focus is those London, Hamilton,
KWC,
Niagara, like all these different places where the average price point is not over that $1 million point.
But we're still well above a Calgary price point.
Yeah.
Oh, even those centers that we mentioned, well above Calgary price point.
Yeah.
And you guys are still feeling comfortable?
Yep. Yeah. And again, we're shorter term, right? Like we can flow through our portfolio in a year. So we're not saying, bullish 10 years, 20 years out, but we're very comfortable lending in today's market.
And we pay close attention to the markets, though. Like we do, you're probably on our monthly economic reports, right? And so we send those out and we analyze them internally as well, and we keep a close eye on what the market's doing. But since, like you said, since that drop off, we've seen it really steady for the last few months. So we're comfortable with Ontario.
Yeah, it's a good point. And we stay really fluid with how we lend. Like our chief risk officer, Dale, is paying a lot of attention to the leading indicators. And if we're seeing issues with supply, if we're seeing values drop, if we're seeing demand drop, we can lower our loan to value. That's the easiest way we do it. So during this downturn, when we were comfortable with the market, we were lending up to 80% of the after repaired value. Mm-hmm. We brought that all the way down to 70. Mm-hmm. We've since brought it back up to 75, so we're not as comfortable as 2 years ago, but we're comfortable. So we have really good levers to look at the data and move our lending decisions around based off of that.
Now I want to talk about lending because it's funny. I've been saying to friends lately. It's never been a better time to be rich, because the quality opportunities, I've never seen so many. Now let's talk about quality opportunities. I've said on the show many times that I personally don't private lend. Right? To me, it's too much work, too much risk. Mm-hmm. The worst case is just too much for me. Because, for example, worst case is if I have to take back the property. Yeah. So for the listeners' benefit, if worst comes to worst, if I need to take control of the property and I need to start making mortgage payments for the first mortgage, I'm generally not happy at all. Mm-hmm. I like the intention of private lenders is for something passive. Yep. Now you went from extreme passive into earn some positive cash flow. Now you're nowhere near that once you've taken control of the property.
A lot of work. Yep. Legal fees. I have to pay someone else's mortgage. Yep. Right? Yeah, like Jesse and I came from the same background. We both were at a syndicated mortgage lender to start, which is one-off mortgages that you're selling. So you get a mortgage and you have a bunch of different individual investors and you send out a whole summary of this mortgage to sell to them and say, hey, this is what we got. Are you interested in participating? So we've been on that side, but now being on the mix side.
Right. I want to elaborate on the syndicated deals you were doing. What kind of deal was it? Was this single family home? Was it a retail plaza?
Yeah, it was all types of deals. Like we do just all typical stuff that a private would at that company. It was purchases, debt consolidation, equity takeout, some construction too, and we just sell those to individual investors. But where you're talking
so for some context, it would be a form of private lending where you, Irwin, are going on title, but there's a professional manager in between doing the due diligence, having disclosure in your best interest in mind. Where what I believe you're talking about is you doing your own due diligence, sourcing your own deal, and going on title.
Yeah. Or even just working with a broker, but yeah.
Well, sure.
Yeah.
Yeah.
And that's even more challenging because you have to do all your own administrative work, all your
Own due
legal
diligence.
stuff, like you said.
Yeah.
So
You do your own collections.
Yeah, it's a very tedious and it's hard work.
Takes
to
a
be able
lot
to
of
do those.
expertise to manage that risk.
Yeah.
Like the way that what I would consider if I was considering that is, what is your expertise? How do you know how to underwrite risk? What does loan to value mean to you? What type of property do you want to focus on? What type of market do you want to focus on? Ask yourself those questions. Also,
Well, the words are due diligence, but with all these failures we're seeing out
Yeah.
there, like we're talking about like Greg Martel and the MMAC, whatever the name of this mick is. We have a developer with 1,000 houses that won't get built. All the deposit money's gone. It's called Stateview in Ontario. Whatever. My point is that everyone says due diligence, and then I generally think a lot of people are have a little bit of overconfidence overconfident in themselves and their ability to do due diligence.
Yeah.
But there's a lot of history out there that people can't.
yeah, we've built a business based off of managing risk with 40 years of intelligence, and we still are learning. So to have an individual with no underwriting experience and risk experience, that's a big task. And
Right.
now, sure, you can do it and make it work for you. But I also even look at deal flow. Like the most important thing as an investor is going to be given the right opportunity. And the way the market has evolved in Canada is you have banks that are getting bank loans. They're getting the top end of the credit curve. Then you're getting B lenders. Let's say they're lending out at prime plus 1, prime plus 2. They're getting those type of deals. Then you're getting alternative lenders, private lenders. Micks are part of that space. Micks make up 95% of that space. So you think to yourself, why am I getting this deal? You're getting the deal because it's been kicked down the credit curve to the point where you're getting the opportunity. Are you going to jump in? Are you the greater fool? Why would the MIC not want to do this loan? Are you pricing it right? Are you managing it right? So there's a ton of questions to ask yourself. Yeah. And
I ask that all the time. If the deal makes it to my desk, I'm like, why do all these other people pass it?
yeah,
Exactly. And then you got to think worst case scenario too. So you go, do you want to manage a foreclosure or power of sale? Like that's worst case, and that's a full-time job. Takes a lot of work. And then the other part of the private lending too is if you're doing it and you do a deal and say you get paid out in a year or whatever, you got to find the next deal to keep that rate of return where it should be. Like you think, okay, you're getting paid 11% on this deal interest and you get paid out. Okay, now what? You better find a deal quick to be able to keep up with returns that MICs offer.
Yeah, if the money sits idle for 3 months and you annualize that, now your 11% is actually 8.75. So what have you really done? And you have to invest a lot of time and energy into properly underwriting. So there's a ton to consider. And you know, if any of your listeners are thinking about it, we're happy to discuss it. And it could work. And we're happy to give you underwriting tips and let you know how we would think about it, because we want to see our industry succeed. And if they're being directed to what's the guy's name in Victoria that's being accused
Greg
of fraud?
Martel.
Yeah, so if
$58 million is missing.
If the public is being directed to the Greg Martels, then that's not good for our market. That's not good for Canadians. So we'd rather give our information and guidance at no cost than have it go to what is allegedly a fraudster in Greg Martel.
Our industry is just scrutinized that much more after these things happen.
Oh yeah,
So,
there's gonna be a reckoning.
Yeah.
For developers and for I don't know, whoever else is going under.
Yep.
A lot of private lenders are having massive issues.
Yeah, the downturns in the market bring to light who's swimming naked.
Yeah. He wasn't always swimming naked though. Apparently, the receiver is accusing him of also, having private jets and luxury condos in several cities, and obviously supercars. And Right? There seems to be a
Right.
commonality that people who have that stuff, they go under.
Whereas Garrett and I are here in Ontario,
You drove your supercar, right?
pinching every penny. We literally decided for our shareholders' benefit that because we like each other so much that we'd room together for this weekend. So like that's how focused we are on the bottom line. It doesn't.
In the book Good to Great by Jim Collins, it was actually mentioned several times. Great companies are quite frugal, right? Like my cousin works at the Walmart head office in Mississauga. I went to visit him. They don't have a cafeteria. It's a Tim Hortons, and it's they pay rent, nothing subsidized. You want to have a meeting with someone, you meet them in the Tim Hortons,
And
right? they're so no frills,
Yeah.
right? They truly are who they say they are,
And that's how you get the lowest cost.
right? Yeah. That's how they get to. Yeah, that's how they keep their prices so down.
Yeah.
Yeah, and that's partly the truth about real estate investing. Most real estate investors are not flashy at all.
No, and most
The good ones.
most wealthy, most truly wealthy individuals are not flashy at all. Like
Yeah.
when me and Garrett were mentioning on the flight here, like I'm looking on Google, LinkedIn for some of our most successful clients, and there's not much about
Yeah,
them. You know, there's no pictures of them driving Ferraris and stories of them living in villas in Hawaii. They've got themselves to the place for a reason.
yeah. A lot of successful people are very quiet about their wealth. Because why would you want to be so public?
Yeah.
What benefit is it?
There's nothing.
There's no. Yeah.
You just put a target on your back.
Yeah.
Yep. Exactly.
Okay, so where were we? Oh yeah. So sorry, I cut you off. We were talking about syndicated mortgages, and then you guys moved into a MIC format.
Well, no, we were at a different company completely. And it's funny because Jesse actually hired me twice. I was hired to Cedar. He left 2 months in. I wasn't very happy with him because he left me, but but he left, and then I joined over at Calvert like 5 years later, and now been with Calvert for 4 years. And this is the MIC model where we take in investor money and diversify it across 800 mortgages in our portfolio. So there's just that. It's still considered a high risk investment when you consider Calvert and a MIC, but it's diversified across 800 mortgages instead of just being on one mortgage, and we're managing everything. So when it comes to a power of sale or foreclosure or whatnot, we're going to manage that. So you're still hands off. And even though we had all these power of sales and not that many, we had 8, we return that 10.76 to you with no management.
Right, to your investors.
Yeah. So
And how often is that paid?
Annually.
Once a year?
once a year. Yeah. Paid annually. It usually goes out on or before May 10th. Financial year end February 28th. Auditors come in, review our books. We build our audited financial statements for board review. Board meets just before the end of May, and we push out our returns and our information to our shareholders then. But from the standpoint of, Garrett mentioned high risk, from the Securities Commission standpoint, we're considered a high risk investment. Reason is we're a private company. We don't have the same disclosure standards as pubcos, and also the liquidity. Like, we're not publicly traded, so if you needed to access your money, you could only access it with us annually. So you would put in a redemption request, and we would pay that out again on or before that May 10th every year. And we also have a gate on the fund where we've seen some funds run into trouble as they don't have gates. So the gate on the fund that we have is up to 10% of the whole fund annually. Luckily, we've never hit that 10%. We've been able to honor every redemption request we've ever gotten. But there is liquidity. Like, to me, one of the bigger risks of investing in any private placement is liquidity. So you got to be prepared to have your capital sit there for at least a year at a time, if not more.
But we're very transparent. Like, we have very detailed financials that we send out, and you can see our entire portfolio and where we sit loan to value wise, which is at 59% right now on average. So
where
we
our
send
money
those
is
out.
placed, like you can see the loan to values on the whole book. You get to see where we're lending, which communities, what we're lending on, residential versus commercial. A lot of great detail, which our analysts or our really sophisticated investors love. That type of reporting. We try to report to a professional company, a public company standard, and operate to a publicly company standard as it relates to how we're governed and audited.
Can I ask what is your budget for reporting?
Well, I think we've.
How many staff are just doing reporting?
Oh, on our accounting team.
Yeah.
Our accounting team is made up of CFO Carl. We have a treasury manager Dom, and then we have 5 staff accountants.
Yeah. Okay,
and then
that's a lot.
And then also a controller, Eric. So yeah, we're a financial institution and we need to operate as such. So we're happy to spend money where money should be spent.
Right.
And to us, it's on reporting and managing our investors' money.
So somewhere north of $1 million a year, in salaries, just in your accounting team.
Yeah. Oh yeah.
Yeah.
Keeping in mind we earned over 30 mil. So.
Oh, so you can afford more.
Well,
don't tell them that.
Don't tell them.
Yeah, don't tell that.
No. We like to strategically invest where it makes sense, and to us, risk is a huge part of what we do. So hiring the best underwriters and risk managers, and accounting are 2 big things for us.
So is this a mick? Is that the official term for it?
Mortgage investment company.
But just because you're in Alberta, you're regulated differently?
The securities regulators in Alberta regulate mortgages differently. So everything that is not one person on one title is considered a security.
So as soon as you syndicate, it's
a security.
Interesting.
Yeah, so
Very different here.
So what's happening in Ontario and BC is they don't have that type of regulation. Although I think they're going that way, and I think this downturn will help them get that way, because you'll see again these private individuals who really didn't appreciate risk and didn't appreciate underwriting.
Oh, yeah.
It worked for them for 20 years because the market is able to mask those mistakes when it's going up 5, 6, 7, 8, 9% on average. Whereas on the downturn, that's where you learn, oh shoot, I shouldn't have been in that second mortgage at 85% loan to value on a $2 million house where I've lent $200,000. That $200,000 is gone now. Plus I can't even protect it because I don't have the means to pay out the first mortgage.
Right.
So we're regulated more closely in Alberta. And a big reason for that is the amount of private investing activity in Alberta, not real estate, like oil and gas. They startups raise a lot of money through those means. So the Security Commission put a lot of good regulations around that, and in turn mortgages got captured in that, which 10 years ago, I remember we went through that process in 2010, so I guess 13 years ago. I'm dating myself. But at the time, you look at it as a business operator and you say, oh, all this red tape, all this stuff, why do we have to do all this? But in retrospect, it really increased the level of professionalism in our industry, and truly did protect investors, which was their goal. So it worked out.
Right, because
don't get me wrong, red tape always doesn't work out like that.
No, it doesn't. But it might have prevented like some of the massive losses we saw in Ontario, like Fortress, Paramount Equity. I'm missing somebody, but we've had I know lots of people personally that they lost money in those things. Yeah, right. And they were hiding under the mortgage regulations. So but to me, they were securities. They were not enough transparency.
Not enough transparency. Like even how the business was being ran with, I'll use Fortress as an example. They were a development company that didn't really know development, and they were raising money to lend to themselves. So it was not a good model for success.
Yeah, I think if they were more transparent, for example, like right away, because I got an idea of what their marketing budget was, and I knew what they were paying for commissions. And then and then the investors caught on the risk for not to my opinion, proper risk adjusted return.
Yeah. And that's a big benefit to Calvert, and something we always say is the fact that we've been in business for over 40 years. So a lot of these companies come up and they're newer, and you got to do your due diligence on their background and how they've done in the past. That's a huge part of
how much money the principals have invested alongside you is important. Like our money, the bulk of our net worth is literally right alongside we're pref shareholders, and so is you if you were to invest in us.
Yeah.
But also, I like what you mentioned, marketing budget. which is something that we've done in a really another way we provide value to our shareholders to hit those high returns is we don't really pay for capital. So our average cost to raise $1 is significantly less than the rest of the market. Garrett and I and our CEO do it mostly through relationships. And because we have had the ability to manage risk, have that long track record, and really transparent financials, we can go to sophisticated investors and raise money.
Right.
So we're not having to raise money from, grandma with a $50,000 TFSA. We can raise it at average check size of significantly higher. So that makes us more efficient. And it also makes us a better company because we're getting to work for really sophisticated investors who challenge us and ask us good questions that make us better. Whereas Granny with $50,000, God bless her, is probably not asking those type of questions.
Mm-hmm. Can you share what is the track record of return? How far back can you go?
Well, we can go all the way back, but I think the two most important numbers that we throw out to our investors is 5-year and 10-year. So 10-year we're at 10%, and 5-year we're right around 10.7%.
And we got to say that
each year,
and we got to say that past returns are not indicative of what the future holds. We're not here to peddle our security, but that's what our return has been. And what I love about the 10-year is it includes the tail end of the financial crisis, because that was the last real big risk event. And through the financial crisis, we didn't lose any shareholder money, and we were able to provide a positive return. The lowest our return got to was just under 5%. Mm-hmm.
Yeah, we say those averages, but whenever we're talking to investors, we're typically telling them that we expect between 8 and 10. If we're lower than 8, we're doing something drastically wrong.
Something's happened in the market.
Something's happened, but we're all striving for over 10 because, like Jesse said, we're all shareholders in this company. We want to see it grow and get those big returns for investors.
So then my question, remember I was trying to get on a call with you. Because my question was, why would someone private lend when they can just be a shareholder of Calvert and to be diversified across 800 mortgages?
Poor advice. Maybe the brokers self-motivated for them to lend their money.
Obviously, they make their commission.
So poor advice, poor research. They haven't understood all the opportunities. But also sometimes, like for us, we don't accept money from non-accredited investors.
Right.
So unless you have an income of over $200,000 or $1 million net financial assets, we're not an opportunity for you. So unfortunately, you may choose to go that route because of that, which is even worse because those people don't really have the financial means to be taking on that risk.
Most of the people I'm talking to are accredited. They've already exited a piece of real estate. They have lots of money.
Well, we don't have a big marketing budget, so we're not splashed all over either, right?
No, we're not selling our investment much, but sometimes people just want that control too. They just want to do the work. There's some people that just
don't have control too, but I know my limitations.
Some people just want to take it on themselves. They think they can do it and have at her. But yeah, it's a good question because we offer similar returns with no work. So, yeah.
Can I pause this? I
sure.
gotta go to the washroom. Sorry.
Oh yeah, Alex, can you pause? We're running out of time anyways. I'll let you guys go soon.
Sorry guys, I had way too much water.
No worries.
Right, left, where am I going?
On your left. Not there.
I think I see it. I got it.
All right. It's only 2,000 square feet, so not big.
Yeah. How many people are here?
We were very flexible.
Yeah.
So my wife has 26 staff or something like that.
Oh wow. Yeah. And okay, so she does I don't know what she does.
Accounting practice.
Oh, okay.
Yeah. Okay. All real estate related. All clients. About 500. Almost all of them have corporations.
Wow.
Yeah.
Nice.
Real estate's been good, man.
Well. That works well.
Real estate's good. It's been good for so many.
Yeah, definitely.
You don't have a corporation unless you're making money.
No, for sure. And she's usually in the office too?
Usually, yeah.
Yeah. Nice.
We don't have, our office isn't as nice as, our setup's not as nice at home. So we like the separation.
I just prefer getting out anyways.
Yeah.
Ever since COVID, it was I couldn't be at home all the time.
Even during COVID, we came every day.
Did you?
We're both
Yeah,
essential
good for you.
services, right?
Yeah.
CRA needs our money, so
Yeah.
yeah, and then realtors were declared also essential service.
Yeah.
So yeah.
Gotcha. So what's next?
Sorry about that, guys.
No worries. This is rinse and repeat, man.
Yeah.
Buy and hold.
Just
Buy,
keep
renovate, and
going.
hold.
Yeah.
Buy, renovate, fix it up, hold. Right.
How many doors do you have right now?
We have 11 properties.
Nice.
Yeah. The thing is, it's expensive here, so yeah, our portfolio is like 11 million, something like that.
Wow.
Yeah.
An 11.
And then the simple thing, like I'm no rocket science. I just tell someone like, get your portfolio to $1 million. Not hard.
2 houses, 1 house.
Yeah.
In your instance.
Market should go up 3-4%.
Yeah.
If it doesn't, selling like on average.
On average, if you look at
Right. 3-4%. That's 30-40 grand.
Mm-hmm.
Like how many people put away 30-40 grand in a year?
Not many.
Right. Almost nobody.
Yeah.
So preferably get up to like 5 million. Portfolio 5 million. Right.
Yeah.
Yeah. But yeah, Trump was on CNN the other like yesterday, and he said he's nuts, right?
Yeah.
He said, "Why don't we just default on the debt?" Can you believe he said that?
Yeah.
Holy shit!
Well, we were
He said-
talking about it today with Nick. He's big, like he's a Bitcoin guy,
Yeah.
and Bitcoin's making more and more sense because as I better understand these debt cycles, maybe not in our lifetime, but at some point,
It could be.
the
man.
U.S. will default on the debt,
Yeah.
and we'll go back to some sort of pegged currency,
Yeah.
and our world will be flipped on its head. So what happens then?
I don't know. Well,
Owning assets is a good thing to have.
good thing, yes. There'll be a lot of messiness in between.
It'll be a lot of messiness.
Yeah.
Yeah.
Like we'll all get blamed. Right?
Oh, yeah.
Right, because we're the haves.
That's why we want
Who the
to.
have-nots gonna blame?
Yeah, that's why it's not the worst thing to keep that profile low.
Yeah.
Exactly. No one should know where you live.
Yeah.
No one should know where your gold is.
Yep.
But yeah, I can't believe I fucking said that. Let's just default because we're going to default on it anyways. Might as well do it now.
Yeah, that's
Right.
crazy.
He's crazy.
He is crazy.
He is.
Still saying the election's rigged and like.
He doesn't mind up setting that apple cart. That's for sure.
Well, my point is though, I think I like that he said it because then I think people start thinking about what happens when that happens.
Yeah, the smartest people are already thinking about it.
Oh, yeah,
So
for
more
sure.
people should think about it.
Yeah.
Yeah.
Yeah. And like the people who are anti-Bitcoin, like you need to. Like gold is so freaking hard to deal with,
Yep.
right? Like you give me a gold coin, how do I know it's real?
Yeah.
How are we gonna find out if it's real?
Yeah. Yeah.
Right? Like the proper equipment. Like remember the old thing? Just bite it,
Yeah.
right? But that's not valid. That's not a valid test for a $3,000 coin,
Yeah.
right? How's this supposed to be money, right? Because money should be risk free. You know, I give you a $20 bill.
It's
you don't have
$20.
any, you don't have any doubt that's not real.
Yeah.
All right.
Yeah.
Yeah.
Right. I hand you a gold coin. Even if I hand you a silver coin,
Yeah. Don't know.
I don't know.
Yeah.
Right. When we go traveling, because like it's a Canadian silver coin. You go to Australia, like what the fuck is this? Right. And it's no longer money.
Yep.
Yeah. All right. We'll get back to it. I don't really talk about these things on the show because then people think you're a conspiracy theorist.
Yeah.
I know Tom and Nick do though.
But in 5 years, you'll be talking about it, I bet.
We'll see. This is the business case. Something there needs to be something digital. All right. Because no one wants to carry around gold and silver and
Yeah.
No.
all right.
Oil or tulips or.
Yeah.
Whatever.
Yeah. Or carry out a barrel of oil to do a deal. It's only worth $60 to a barrel of oil. But yeah, we need some sort of digital money.
Yeah.
That's fixed.
Sorry.
That's hard.
We have a condo being listed, and I'm in this group chat that's just exploding my.
Is it sold?
No. We're just about to. He just sent me the listing to check out.
Okay.
All right, where were we?
We just finished investing in Calvert.
Yeah.
We're investing into mix.
Anything else we should talk about the fund? So,
I don't know. We don't get into like the numbers too much. I think we left it where we typically would.
Yeah. Well, I guess if
Other than history.
we'll talk about if the listeners want to reach out at the end.
I want you to be specific though. Like, what kind of deals should people bring you?
Oh yeah. So let's talk. Let's ask that. Yeah, good idea.
I was talking to this novice. All right, Adam, ready?
Yeah.
Can we just jump back in? All right. Ready?
Yep.
So I was talking to this novice investor who's looking to invest in Florida, right? They're Canadian, never done anything in Florida before. They'll have trouble getting financing, they know. But then the suggestion came up, she came up with something that's been suggested to her, is she'll just borrow private money as her primary financing.
Mm-hmm.
But it'll be like 10%. And I'm like, in my experience, that's expensive, and that's for short-term use.
Yes.
Yep.
Right? And they're like, oh, well, as long as the numbers make sense. I'm like, I don't know what deal will that make sense.
Yeah.
Because if that deal made sense, it should make sense to a lot of people.
Mm-hmm. Mm-hmm.
Right? But yeah, you guys make money lending it out.
Yeah.
Even you think 10% is not something you do for long term.
It's not sustainable. That's why we want to be that short-term option. We make sure there's an exit.
Yeah, you don't want to lend for long term either,
No.
do you?
No, we
not at all.
want we love shorter
Quick.
periods possible.
Yeah.
Even
and
though you're
like-
getting a great rate, you don't even want it out there.
Yeah, and I think a lot of people know that we do a lot of financing for real estate investors, but we also love just any sort of short-term stuff, like a bridge deal where the purchase and sale dates don't line up. But there are other instances.
That's a good one actually, because I'm
Yeah.
hearing a lot of bridge loans are needed these days.
Yeah,
love
and we're
that.
happy to do them. Like those are great loans that are quick and people just are in and out. So the interest rate is less relevant, right? When it's a month bridge. But the other one too is just
and also, how long does it take you to put together a bridge?
oh,
Because usually you're finding
Yeah,
out late, are you not?
He could close the deal tomorrow.
well, maybe not that quick in Ontario, but
In Alberta,
Close.
in Alberta,
In Alberta,
we
we
can close
could.
the deal tomorrow.
right,
In
but
Ontario,
Ontario
because of,
about 48 hours.
Right.
If you send
Because
us
you're
all
usually
the
finding
info.
out late in the process that someone needs
Yeah.
a bridge.
we're
Exactly.
in the 11th and a half hour. My
Exactly.
bank fell through. Here's why. Help me.
And there's also, when you're saying the 11th and a half hour, it's the same with when the bank has a bunch of conditions and we're coming up on the date they got to purchase a property, and maybe the appraisal comes in and says the property's fair condition or doesn't look the way they want it. And they've got 3 days to close. They're like, what the heck do I do? So we're that option that's super quick for clients. We do our internal values so we can turn it around really fast, fund it for you. You can maybe do whatever the bank needs you to do and then jump right back to the banks and hold it long term. And maybe that's their primary residence. They just couldn't get the bank financing because they pulled it last minute or something like that.
Which happens.
But
What
we-
is
yeah.
delays in closing?
Happens all the time. Yeah.
Yeah, so we want to be that short-term solution, but there are other things that we do other than real estate investor focused stuff like this, where it doesn't have to be a big reno or something, but we want to be that option for people.
New to Canada, come with capital and a job, but they don't have the job history or the credit history.
Got to be a citizen, but
They got to be a citizen. They see a house that they love, good value. We see a clear line to them getting bank financing in 4, 5, 6 months. We want those loans. So what you said is, yeah, we're getting a great rate for our risk, but risk is the key thing there. And when we're getting paid out, the risk goes to zero. So we love recycling our money. It benefits our shareholders. It benefits our risk profile. So that's what we want to do. So your friend who's buying in Florida, let's say she was buying in Calgary, and
I may even suggest it to her just for the price points.
and there were a clear. Let's say she had to go for whatever reason, new to Canada, couldn't close quick enough with the banks, whatever. But there's a clear line for her to get bank financing. We want that loan, and then we'll coach her if needed. We'll get her with the best mortgage broker. We'll do whatever it takes to see her succeed and getting rid of us. That's where we see successes when they exit the loan.
yeah, like most people know us as the real estate investor focus, which we are. Like we still love doing those deals with people who are flipping and burring, but we also do so much other stuff to be able to finance things short term. Yeah.
And then, so what kind of investor deals are you looking for?
In terms of real estate investor?
Yeah, real estate investor deals.
Well, it's like we talked about before, where we are focused not as much on the GTA. Typically houses that are $800,000 and less, but we still go above it. So we want to be in that sweet spot. And then we also want to make sure we're in and around the urban centers. We don't want to go too far out, so we're not going way rural Ontario.
What's a population minimum floor?
So
50,000,
within
10,000?
within 10,000 people, or sorry, a city that has 10,000 people, we can lend inside that city. So it can't be outside that city. And then we do cities with 50,000 people within 10 kilometers of that. And then 100,000 people will go 25 kilometers outside of that.
Yeah.
So it's urban centers where we're wanting to stay close to some sort of city.
Yeah, I was just looking in our portfolio composition for Ontario. 82% of it is the 100,000 population and within the 25K of. So that's the bulk of what we're doing. But really, who we want to support is firstly real estate investors that we see them making money.
Yeah.
On residential projects, short term, flip or BRRRR.
Our two main underwriting criteria for flipping a house is, are they going to be successful? Like, are they going to be profitable? And do we think they are going to be via our valuation that we do internally by our internal evaluators? And then two is, do they have the money to complete it? So that's the down payment, the renovation costs, and the carrying costs. So seeing those two things, and then we obviously review the rest of it: app, credit, notice of assessment,
their
as a full
expertise.
deal, expertise. And if they have a lot of expertise, we probably won't have to dig in as much as we would a new investor and make sure that they have a good plan in place to be successful. Because ultimately, this should be mutually beneficial. It should be, okay, you're coming to us short term, but you should also be making money on the back end, whether it be a BRRRR or a flip.
Yeah, we want to work with these clients for life. And we're not going to get the opportunity to do that if we don't set them up for success. And then finally, mid to lower half of the market. We don't like high-end stuff because what we've seen historically is when there is downturn, that high-end stuff gets beat up the most. Also, there's just less of a market for it, right? Like there's just more liquidity in the mid to lower half. When economic turmoil hits, a floor usually establishes for real estate, but the height usually gets compressed quite a bit. And there's just less transactions in the high-end space. So we love mid to lower. And for that reason, most of our investors are already looking at that. It's not like we have to say, no, don't buy that $5 million house and renovate it, because they're not considering that. Yeah.
Right. Cottages? Is that something that... No?
No.
Yeah. Because
of what we just talked about.
Exactly what we just talked about.
Like, it's great until it isn't. And it's amazing how many investors thought it was great over the last 3 years. And now that people
Several are holding the bag.
struggling with really big payments, they're letting go of those cottages. Where there's supply, it's in some of the rural cottage areas. Yeah. There's no supply in urban centers where people are working and living.
Right. And also, that seems I've been hearing from many people, bookings are low on Airbnb.
Yeah, when the economy struggles, that those discretionary type income endeavors get cut back, and you always need a place to live,
right.
But you don't need a place to vacation necessarily.
I do think part of it is because their borders are completely open, so I think more people are leaving as well.
That's true too.
They're choosing other vacation. Yeah. Because my friend that went to where'd she go? She went to Italy in October. And I said, why'd you wait till October? You're almost past shoulder season. She said Italy was sold out in September. Wow.
Yeah. A lot of pent up demand for travel.
Yeah, way pent up. Yeah, there's still lots of money out there.
Yeah.
It's an interesting world of haves and have-nots. And folks need to make a decision which one they want to be a part of.
Yeah.
All right. Where can people follow up with you if they want to learn more about this?
Website. Check out our website, chmic.ca. We have Instagram, Facebook. Check those out. We have a lot of educational content that we post. And all our contact information is on the website. So check that out.
Yeah. So everything you see on our website and social is going to be geared towards educating real estate investors and borrowers on how to make good decisions. if you are looking for investment information, reach out to Garrett or I. We don't publicly have that information available.
Right. Because you're not allowed to, or you don't?
We don't. We could technically. We choose to for a few reasons. It does go into the gray area as it relates to securities rules, but also competitively, we don't like to have it out there, and also because of how relatively guarded we have our shareholders, we like it to be relationship based. So we don't want every person in the public calling us to be a shareholder. So we're more than happy to share our information. Like we've said, we really take pride in our transparency. So you can reach out to Garrett or I. Our emails are just our first names at chmic.ca.
Right. And the I don't know if you noticed, but what you just shared right there, so different than people who are trying to raise capital on social media.
Yeah.
I guarantee returns.
Yeah.
Call me any time of the day.
None of that. The disclosure was even thrown out there. So,
Yeah. I hope it's
we're
adequate.
close guarded.
Yeah. So
For listener, I'm trying to highlight the fact, the difference between when you're licensed in securities and how you present opportunity versus how someone who took a weekend course represents opportunities on social media.
Yeah.
Thanks so much for doing this. Thanks for coming in all this way just for me.
It was just for you, Erwin.
Yeah.
Thanks for having us, and thanks to your listeners for hopefully getting a little bit of education. But we love what you do. We love your platform. We love the fact that your mission is education, and something that we hold near and dear to ourselves.
Yeah. We appreciate it, and thanks for having us.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.